Hey everyone, a little different video today. Had a request that I review a video on retirement withdrawal strategies. So we'll take a look. I'll share my thoughts and yeah, let's go ahead and get started.
One of the most confusing decisions retirees face is choosing the right withdrawal strategy from the dozens of them that are out there. In today's video, we'll
Just real quick, I mean, I definitely agree. That is one of the most confusing things. I put on top of that actually managing that in retirement becomes particularly difficult. You will see people that maybe were really great at accumulating throughout their saving up years until they got to retirement, but then they actually transition into retirement, and that's a whole new challenge for actually setting a strategy, but then not just setting it, but managing it and maintaining it. Definitely is something that's a challenge. And some of the strategies that might have some things that are appealing about them, unfortunately, they're so complex or just so hard to implement that they become pretty difficult as you get farther into retirement. But we'll see what he has to say here. Just want to jump in
solve this problem by breaking down the best one for most of you watching. Over my many years of working in the retirement space, I've analyzed countless withdrawal strategies, testing each one against real market conditions and actual retiree spending patterns. This is why today I'm going to share with you what we have found to be the most effective withdrawal strategy after reviewing over 25 different approaches. So let's get in.
And real quick, obviously I have my bias here. Justin Fitzpatrick and myself, we really kind of coined that term risk-based guardrails around the concept of setting a guardrail strategy. I'm not sure where this video is going to go, if that's going to come up, but do like to be transparent, right? If you were watching a video and we're talking about Guyton Klinger guardrails and we had Guyton Klinger on, obviously there's going to be some bias there. So I want to be transparent about that before we get into this video and see exactly where it's going.
Good. Your withdrawal strategy is essentially the rules and the method that you'll use to determine how much you can safely afford to spend each month or each year from your retirement savings. It's the foundation for how you pay yourself and you replace that steady monthly paycheck when you're no longer working. You might say, well,
maybe a little bit of a nuance. He just mentioned how you replace that steady monthly paycheck. Obviously some strategies are going to have more steady income. Some are going to have less steady income. It's probably something that I'm sure will be addressed, but just want to make that note.
Don't you just take money out of your 401k to pay your bills when you retire? Isn't it just that simple? Yes, it is as simple as taking money from your savings and sending it over to your checking, but how do you ensure that we spend the right amount of money from the right accounts? That's where having a strategy becomes important. You don't want to overspend and run out, and you don't want to underspend and sacrifice your lifestyle, and you don't want to pay extra taxes because of the order in which you decide.
Yeah, I wish I would have paused that a split second sooner, but that second point there, that you don't want to underspend, I'm glad he's mentioning that. That's a really big one that a lot of people miss. A lot of the strategies, 4% rules, some of those, they're so conservative, so ultra conservative that what you end up doing is drastically underspending in retirement, often without a mechanism to actually ratchet that up. So far, I like where the video is going, and yeah, let's see where we go.
Decided to take that money out. Now, you would think that there would be a simple way to do this that doesn't require a PhD in finance, since almost every single person in America with a retirement savings is going to be doing this to fund their retirement someday. But if you're looking for a simple way, you could end up reviewing at least 25 different retirement withdrawal strategies, and that's not so simple. I'll name just 10 of them for you right now. You've got the bucket strategy, the CD ladder strategy, 4% rule, the endowment method, floor and ceiling strategy, income flooring, time segmented strategy, asset location strategy, dividend income strategy, spend more early strategy.
Now, I know he's not doing like a detailed dive in each of these strategies, at least yet. But one thing I would say, some of these strategies, right, the way people talk about, say, bucket strategies, I don't think they necessarily are something that can't be combined with other strategies. So, again, I'm a big fan of risk-based guardrails. I think you can use risk-based guardrails with a bucketing strategy, although maybe it's a little bit more of a psychological type of tool in how you think about your buckets. At least that's where I personally land. I don't actually personally see a lot of value in using like a very substantial cash bucket that's overly complex. I think sometimes people do make those strategies try to be too precise with them, when really just directionally making sure you understand how much you have in different buckets. But just want to know, I don't think these are all necessarily mutually exclusive, although certainly some of these are going to be very different types of strategies.
And the list goes on. And in this video, I'm going to nerd out a little bit and share with you my favorite withdrawal strategy for most people, because it tends to match what a happy retirement looks like, and it does a good job of helping you to fine-tune your spending as you go throughout retirement so that you get the most use from your savings. Whether that be to personally spend more of it or just to feel confident in gifting some of that money away and avoid dying with way more money at the end of life than maybe you want. But it would be helpful.
I do like that he emphasized that gifting there. That is something I run into a lot. And, again, we're probably going to get there as he actually gets into the strategies more, but with a risk-based guardrails type of plan where you actually have some way of adjusting on the upside and increasing that spending down the road, sometimes people look at that and they're like, I honestly don't have anything I want to spend money on. And that's a good time to think about it really as, okay, well, you may not want to spend money on this, but perhaps there's something you'd want to gift to charity. Perhaps you'd want to give something to family. It might be somebody that you can help out. It may not be your direct consumption and spending, but that still is a big deal for a lot of these strategies that are ultra conservative and lead to somebody just not spending much from their portfolio to begin with.
Before I get to that, I cover just a few of the pros and cons of some of the most popular income withdrawal strategies first. One of the most simple and straightforward methods is the fixed dollar withdrawals. It's just like it sounds. It's a fixed dollar amount that you withdraw from your savings. First, you calculate a starting amount based on anywhere from 3 to 5%. And so if you have $1 million in savings and you choose 5%, then you'd pay yourself $50,000 per year. And you would do that for a set amount of time, say 5 years. And at the end of 5 years, you'd reassess that fixed dollar amount for another 5-year period. Now, you'd want to do a couple of practical things as well. For example, you'd want to take that $50,000 and you'd want to divide it up to a normal paycheck for yourself. Most people prefer to pay themselves monthly. You also want to make sure that you keep your portfolio properly allocated to support growth against inflation. And lastly, you want to pay attention to your actual distribution rate as time goes on. For example, a $50,000.
Before we get into the example here, a few things he mentioned. I do like the monthly payment. To me, that's usually the best frequency in retirement. It's not too much, although you certainly could, in many cases, automate a more frequent payment frequency if you wanted to, but monthly is a pretty good balance in my view. Also really like to look at that after tax, right? So, obviously you're distributing from a brokerage account where you might have capital gains. That's going to be a different situation than distributing from an IRA where that might be all taxable income. So just things you have to be thinking about. But ultimately, I do like having this number, kind of this after-tax target monthly spending amount that's going to go to our account. I do think that's a good frequency to be looking at.
$1 coming from $1 million represents a 5% withdrawal rate. But if your portfolio value were to drop, say to $700,000, that would be a 7% withdrawal. And you'd want to keep an eye on that to make sure it doesn't threaten your success. But why do I not love this strategy? Well, it's because your monthly withdrawal loses purchasing power over time because, as you know, some years can have higher inflation than others. And I also don't like it because people tend to not check in and keep an eye on their withdrawal percentage. And even when they do, if it does get too high, they need to abandon the strategy altogether and use some additional tools to course correct. Now,
yeah, the course correction here is a big deal. Right? A lot of these strategies, they might say, okay, here's how much you can initially spend, but they don't tell you what to do if you get to the point where it is calling for a correction. Now, he mentioned adjusting it every few years, so I do think that's where the mechanism here would potentially come in, right? If you're reevaluating a few years down the road, applying the same percentage, the portfolio value's gone down, that is going to bring down the distribution. But also when you're looking at a strategy like this and you're really targeting like a 5%, 4%, 6%, whatever the number might be, that's really going to lead to a lot of spending volatility. Even if you are, looking at a 5-year window and then doing that, that itself isn't going to get rid of too much of the volatility. You're going to see pretty big jumps often when you get to that 5-year mark. You could do things like try and smooth it out. So take the average balance over the last 5 years. That'll do a little bit more to smooth that out. That becomes more of like an endowment type spending strategy. But even in that case, when you're doing that, and I've written about an endowment type strategy on the Kitsis blog before, but when you're doing that, you're going to wind up in a situation where 5% is actually a very low amount to be distributing because you know that as the portfolio moves around in balance, even if it's going down, it's naturally resulting in a lot of reduction in how much of a distribution you're taking, and often too much of a reduction, or in the sense that, as your time horizon has gotten shorter, it might be realistic that you could distribute a higher amount than just 5%.
Let's talk about another strategy called the bucket strategy. The bucket strategy, just like the name, has different buckets that represent different time periods.
Before we get into this, there are a million different types of bucket strategies, so there's some commonalities. I'm guessing that's what he's going to get to, but just so you know, if you know of a bucket strategy, it might be a little bit different than what we're going to look at here.
Each bucket serves a different purpose and therefore holds different types of investments based on when you will need the money. A simple 3-bucket method would hold 2 to 3 years of spending in bucket 1. Spending for years 4 through 10 would be bucket 2, and spending for years 10 and beyond would be located in, say, bucket 3. Of course, bucket 3 could be invested most aggressively, since you wouldn't need to touch that for many years, and it could handle some of the market volatility. Now, there are 2 things that people get wrong about this strategy, and that is sometimes people think that having more buckets means better results, and they overcomplicate it. But 2 to 3 buckets works just as.
Totally agree with him here. I do see people that just really try to make way too many buckets, make it way too complex. Even advisors that I see trying to set up things where they're trying to use individual bonds and things like that to really try and perfectly match these different buckets over different time periods. And to me, that's far too complex than you need to be. And it's going to only make it more and more difficult to actually manage that and implement as you're going through retirement.
Well as 5 or 6 buckets. The other thing they do is that sometimes they overload their cash bucket, holding too much low yielding assets, which hurts their long-term growth. Now, there's only one thing.
Just going to agree there too. I think a lot of times when you get too much in the cash, you're getting that cash drag that you're adding into the plan. I do think it makes sense to have like an emergency fund, some additional funds that somebody is keeping in like a high yield savings account. But I would not get crazy with trying to put too much cash into a plan. I think you're going to be fine often using a bond fund or other type of vehicle to really try and get that same sort of result.
That I personally don't like about the bucket strategy, and I'll tell you what that is, and then I'll tell you what most people do like about the strategy. So the one thing that I don't like is that it can be a hassle when it comes to rebalancing. And it can be messy when you need to take your required minimum distributions from that bucket that maybe you didn't really want to take it out of, and then you're left trying to figure out the logistics of how to best rebalance the buckets, rebalance the allocation, figure out how to be tax efficient with the order of your withdrawals.
Yeah, absolutely agree here. They do tend to get more complicated when you're moving things around, and it's particularly hard to even target a certain type of allocation, right? At that point, each bucket kind of has its own target allocation, and it's going to be defined a little bit differently when you're looking at each bucket, but you really are going to have a hard time saying, okay, here's exactly the broader allocation I want, and I'm going to try and rebalance. That's difficult when you have to take into consideration across different accounts. It can also be difficult when you're looking at things like asset location, think about where you're holding different investments. Yeah, I mean, to me, like you said, it adds too much complexity when you're actually trying to implement it that really fine-tuned level.
What I do like about the bucket strategy is that the buckets communicate a peace of mind when it comes to market volatility. And they instantly know they have 2 to 3 years of expenses tucked away in bucket 1. This gives them the space to not panic, and ultimately they sleep better. The bucket strategy also has built-in risk management. If you think about it, each bucket naturally matches your time horizon. You're not taking unnecessary risks with money that you need soon, and you're also gaining the confidence to be more aggressive with that bucket number 3 because you won't need that for several more years. The bucket strategy also provides a clear purpose for your money because every dollar has a job.
Yeah, I'm totally in agreement with him here when it comes to what the actual benefits of the bucketing are. Michael Kitces has a great article. If I remember, I'll try to link it below, where he talks about the psychology of bucketing. And I think that's really where you get most of the benefit. It's not so much the actual management, right? It's not actually doing anything different from a portfolio perspective to manage too much risk. It's more the psychology of thinking about where different things are and what their function is in your portfolio. And when you break it down like that and you start to think like that, I think people do become more comfortable with the idea of, yeah, I need to have some sort of stock exposure within my portfolio to get that long-term return that I'm looking for so I can protect against inflation and otherwise accomplish my retirement goals. So that's the big deal for me. And that's why buckets in particular, I don't think you have to think of them, right? Even if you think of using some other type of strategy and you think of, okay, let's say, look at my cash and my fixed income portion of my portfolio as its own little bucket, as its own sort of, I like terms like, protection bucket or something like that. And then you think about how many years of expenses can I cover with that, say 40% allocation to fixed income and cash. And if you think about that and that comes out to be a number that's something like 10, 15, 20 years, I think you can be very confident that, okay, yeah, I'm in a position where I have a lot of protection here. I could ride out the ups and downs of the markets if I really didn't want to rebalance my stock allocation. And that's ultimately where you're getting most of the value.
I think that point is very important because sometimes a retiree will want to spend more money from another area of their plan and they don't realize that those dollars are actually working for their future need. Let me give you an example. One day, a financial planner finished reviewing a newly created retirement income plan, and the husband made a passing comment. And he said, well, maybe someday we'll buy that condo, who knows? Right away, the planner had to point out that those dollars might be needed for the sustainability of your plan. We don't know, but we need to check. So the bucket strategy seems to overcome that problem because they can see that they're robbing for their future to spend some money today. Now, as a side note, since how much you withdraw is just one piece of your retirement puzzle, this video alone won't tell you how prepared you are for retirement. And if you'd like a little more hands-on help of understanding how on track you are for retirement, I've put a link in the video description to an entirely complimentary quiz that'll help you understand your exact situation. It'll walk you through a list of questions to see if you're on track to achieve your financial and retirement goals. All you got to
Now, minor disagreement here. I'm not so sure that the bucketing strategy to me does a great job of talking about that sort of assessment of long-term risk. How do we spend more or less? If I'm taking a big distribution, let's say somebody wants to go on a trip, they want to fund something, and they're really wondering, can I afford that? And what's the impact on my long-term plan? I actually think risk-based guardrails are going to do a much better job of that because it's going to show you, here's what you could spend today. Here's where your portfolio, you'd hit an upper guardrail, you'd hit a lower guardrail. Where are you, in between those guardrails? And that's a lot more insightful to me, right? Because that could tell you, okay, yeah, you could take 50,000 out of a portfolio. That gets you this much closer to a lower guardrail. If you hit that lower guardrail, now you'd have to make an adjustment. With the bucketing strategy, you really don't have any of that. So to me, I don't know that it really provides that same benefit. But again, I'm mostly in agreement with him here that psychologically, that's the real big value of a bucketing approach.
do is simply click the link below and take the quiz. All right, next let's discuss the 4% rule. This rule is talked about a lot online. It's similar to the fixed dollar withdrawals method in that you start with a percentage of your total, but it's different in that you adjust it for inflation in the following years. $1 million in savings, for example.
Yeah, I'm glad you pointed that out. That's one very common mistake when I see people talking about the 4% rule, especially when you get to some of these more influencer type TikTok videos. They're trying to do it really quick. A lot of people will gloss over that, that you actually are getting a true inflation adjustment. If you go into Bangen's research on this, right, he's actually using like CPI, true adjustments for inflation. And we're looking at, okay, what was inflation for the year? What would somebody need? So when you're looking at periods where, 70s, early 80s, when we had high inflation, that actually is built into that true market inflation rather than just some sort of assumption like 2% or 3% for inflation.
Would mean that you spend $40,000 a year in year one, but in each subsequent year, you would increase that $40,000 by an inflationary amount. So for example, the year two payment to yourself would be $41,200, and year three would be $42,436, and so on. Now the strategy is
just real quick on that, that's another one where, from a practical perspective, unless you're using some sort of tool that's actually helping automatically figure out what that inflation adjustment is, that is one that becomes rather complex, right? Most people aren't looking at, okay, CPI was 4.5% last year, so I'm going to increase my distributions exactly 4.5%. That's just not how most people actually spend in retirement. And if you look at even things like David Blanchett's work on the retirement spending smile, you'll see that most people don't give themselves a full inflation increase. We actually see that spending tends to increase, but increases at a rate lower than inflation. So To me, not really a practical type of way unless you're using some sort of tool that's really going to help guide you along the way in doing that.
Is that you would maintain your portfolio around 60% stocks for the long-term growth and then 40% bonds. And a lot of people don't actually recognize or realize they should be doing that. And it would be really bad for them to use the 4% rule and not have their portfolio properly allocated. The 4% rule can be good for eyeballing how on track you are in your retirement saving, but other than that, it's been criticized to be used as a standalone withdrawal strategy. If you look around online, you're going to find people hating on the 4% rule. In fact, the person credited for discovering the rule says he never intended for it to be used blindly. He was simply trying to find an answer to the question, what is the highest percentage a retiree could safely spend and not run out of money over certain time periods?
Yeah, I think this is a really important point. The 4% rule was an academic exercise, right? That the research was published in Journal of Financial Planning. Bangen wasn't necessarily setting out to say, hey, this is a strategy you should actually use and this is how you should actually generate income in retirement. It was more of an academic exercise to say, okay, if we have these parameters we're looking at, we're pulling from a portfolio, what is it that somebody could have spent? And I think he has a good podcast with Michael Kitces where he dives a little bit deeper into that and how this really wasn't meant to be a rule. This was really just meant to be some research that helps us understand. But there's a lot of issues with 4% rate methodology when it comes to how realistic that is for mapping over into how people actually spend in retirement. So yeah, I'm with him here that this isn't something you can really use in a practical sense, and that was never the point. That isn't what Bangen was trying to do.
It also became known as the safe withdrawal percentage. I'll highlight a few of the criticism. So first, it's inflexible and it doesn't match how retirees really spend in retirement. It's difficult to figure out how to account for other spending goals outside of the rigid income distribution. It's meant to survive a worst case market scenario, so it's overly conservative for almost everybody, and you're likely to be forced to live more frugally than you need to.
Yeah, again, going back to those points, I should have paused just a split second sooner, but especially thinking about the upside, Michael Kitces has another great article on the tremendous upside potential that comes when you're using a 4% rule. And really what happens, yes, it worked in the worst case scenario to make sure you got through that 30-year retirement period without depleting a portfolio. But in most historical scenarios, you actually ended up with a huge pile of cash at the end of your plan, right? And that's where people, yes, I mean, maybe they wanted to give some of that to their kids or somebody else, but I think sometimes there's so much more impactful giving we can do. Even if we ultimately do want to give that money, we could give it to charitable organizations while we're alive, and we can see what's done with that. We could give it to our children when they're younger, and maybe that's much more beneficial and helpful to be able to go make a down payment on a home versus inheriting an account when they're in their 50s or 60s and it really doesn't do anything for them. So to me, that's where, again, guardrails are going to be so much more useful than just a 4% type of approach.
Now that we've reviewed a few strategies, let's move into what I think is the best one for most people, as the title of the video states. And in my opinion, nothing compares to risk-based guardrails.
Love to hear it. Awesome. Obviously, again, I've got my bias, but yeah, glad to see this where we wound up.
Everyone wants a simple solution to something that can be highly individualized and very comprehensive. And all the other withdrawal strategies tend to focus on the simple aspect, but those simple rules that they use, they get thrown out the window as soon as you have a complication that the strategy and use can't account for. Guardrails are fantastic because they communicate something very simple, but they are deeply comprehensive. Risk-based guardrails monitor your entire financial timeline and your future expected spending, and it provides you with your total spending capacity. That is, how much is it safe to spend and still have a high probability of reaching all of my goals?
Now, maybe he'll get to it. He hasn't mentioned it yet, so I just want to clarify. Totally agree, with the overall high-level things he said here. There is a difference, though, between risk-based guardrails and withdrawal rate-based guardrails. So there are other guardrails methodologies, Guyton Klinger, Kitces' ratcheting safe withdrawal rate. There's a number of them that are really focused on actually using the withdrawal rate to determine when you should increase or decrease spending. So a really simplified version, maybe you start with a 5% distribution. If it gets to 6%, you hit that kind of the lower guardrail in that case because the portfolio has gone down in value. So you cut your spending, maybe to stay at a 5% rate. Or if it falls to 4%, meaning the portfolio has grown, and so now your distributions are a smaller percentage of the portfolio, then you would increase that again to get back to a 5%. But that's not Guyton Klinger specifically, but that's kind of just a really quick approximation of what a withdrawal rate driven guardrails approach would be like. And those tend to have all the same issues as the 4% rule because most people don't actually spend in that pattern. They spend in a much lumpier type of way. It's not as constant. Maybe they're delaying Social Security. All sorts of reasons why those distributions aren't constant from a portfolio. And that's what really separates risk-based guardrails, which are able to accommodate for any idiosyncrasies of an individual's plan, versus more traditional types of guardrails, withdrawal rate driven, where you're not going to capture any of that nuance.
They involve a bunch of complex information about you and your financial story, and then they distill that down into answering 3 questions for you at all times. And these 3 questions are all that really matters to a person who's trying to just really enjoy their retirement. Question number 1, how much can I spend each month? Or how much am I on track to be able to spend when I someday retire? Question number 2, am I still on track? And number 3, how will I know if I'm not on track? It communicates this through placing a visual guardrail below your portfolio and another one above it. And you can just visually see how much it's safe for you to spend each month. And you can also see what the plan would be for you if your value were to increase and you hit that upper guardrail and you would begin spending more money. And of course, if that lower guardrail was hit, indicating a pre-planned reduced amount of spending. It does this because if you remember the 4% rule, the 4% rule goal is to avoid disaster during the most extreme situations. The thing is, those extreme situations do not happen for the majority of retirements, leaving people to vastly underuse their retirement savings. So with risk-based guardrails, we want to know when it's okay to spend more, but we also want to be able to identify if we do run into those situations.
Yeah, I'm just letting him go here. Don't have anything really that I disagree with or look at differently. I think he's doing a good job explaining how the guardrails work.
These guardrails are tailored to your specific retirement story. That is your individual needs and your personal risk profile. For example, if you're paying off your RV for the first 5 years of your retirement, the system will allow for extra spending that might be above your safe spending capacity, but then it smooths out your spending, accounting for the fact that the extra payment for the RV is going to go away.
Okay, just a nitpicky type of thing here. I mean, yes, he's absolutely right. One of the big advantages is if you are buying an RV or you're traveling or you're gifting, whatever it might be on the front end, risk-based guardrails can absolutely account for that. I wouldn't say that it's spending above, and I don't think this is what he meant to convey, but I wouldn't say that it's above spending or your safe spending capacity, right? It's all going to adjust that. So it's going to say, if you take those distributions on the front end, what is your safe spending capacity, which I think is the point he was actually trying to make. Again, I'm being kind of nitpicky with the language, but I just want it to be clear that it isn't like solving for a long-term safe amount, and then it's basically saying, okay, you're spending extra. It's saying, okay, because you're taking this extra on the front end, that's going to bring everything else down in the long term.
At a very high level, they use Monte Carlo simulations to determine where the lower and upper guardrails should be placed in your plan, and those simulations update every 30 days.
Yeah, this is true. You can definitely use Monte Carlo simulation. It's not the only methodology you could use, though. And actually, within Income Lab, which looks like it's the tool he's referencing here, within Income Lab, you could even set it to do historical simulation. You could do regime-based Monte Carlo, which is more advanced, where you're basically taking, instead of just Monte Carlo with one set of capital market assumptions, you're assuming, okay, in the short term, we might have current market conditions, and then we have more of a long-term market assumption. So you're able to take some things like the current market we're in into account a little bit better. Justin Fitzpatrick and myself also have an article where we're testing to see which one of those historically actually worked best in terms of predicting from a planning perspective. And historical simulation and regime-based Monte Carlo, I think, really won out. Personally, I like historical simulation. I think it's the simplest. It's actually capturing some market dynamics that are very much real market dynamics, in the sense that it's capturing momentum and reversion to the mean and things that we see in actual kind of stock movement that a Monte Carlo simulation is not going to pick up. So Monte Carlo simulations, you tend to get these more extreme kind of tail situations because if it says that you have a 20% year return in year one, 20% year return in year two, 20% return in year three, that might just be the random draw you got. But the next year is still totally random, right? It's not saying like, well, in reality, if we had a bull market like that, valuations would go up, and we would actually expect the next year's returns potentially on average to be a little bit lower, right? So that's where you can pick that up a little bit with regime-based Monte Carlo. Historical simulation will pick that up, but Monte Carlo simulation itself won't. So again, technical point here, you could really use any different type of analytical method underlying setting the risk-based guardrails. But personally, I like historical simulation a little bit more than Monte Carlo.
It's a highly technical process that uses constantly updated information. Information like your changing age, the current capital market assumptions, and how they change as the world changes. And this all reflects a dynamic living financial plan, one that stays current. Again, simplicity on the surface, but a lot going on behind the scenes. If you want to...
Yeah, I think that note he made there is actually a very important one, because if you go back even earlier in this video, I talked about how complicated some of the other withdrawal strategies are to calculate over time. And risk-based guardrails actually, they do have the complexity on the calculation side of things, right? You really probably want to be using a specialized tool to set that, especially if you're somebody that's going to be using that as an ongoing basis going through retirement. It's not something to me that is ideally done. I've written about how you could use just a traditional Monte Carlo tool to do it. It's very cumbersome. It takes a lot of time, a lot of guess and check, and it's not something, as somebody's potentially also dealing with cognitive decline, getting into their advanced age, 80, 85, 90, 95, that's not something I think somebody should be doing for themselves. It really is ideal in a situation like this to be working with a professional who is like-minded, sees the value in that sort of approach, and it can help guide you through that process rather than trying to do that yourself.
Look at the risk-based guardrails in more detail. Watch the video that I made. It's titled "The Withdrawal Strategies That Rich Retirees Use That Poor Retirees Don't." I also should point out that risk-based guardrails are not the same thing as traditional guardrails.
So he got there. Obviously, I went over that a little bit earlier. I'm glad he's touching on it, but yeah, definitely different
Traditional
things.
guardrails are completely different, and the only thing they have in common is their name. Traditional guardrails can likely cause people to spend less than the 4% rule, even though they start out spending a higher rate than the 4% rule. They don't consider the entire financial picture holistically, and their biggest flaw is that they have no way of looking at your future spending plans. So if you earmark money to, say, cover long-term care, your guidance for your withdrawals aren't reflecting that future goal for spending. Now, if you didn't catch that, no worries. As long as you know that risk-based guardrails are different than traditional guardrails, you'll be good.
Yeah, and just to elaborate on that, if you Google retirement distribution hatchet, again, I have an article with Justin Fitzpatrick at the Kids' blog where we talk about that specifically, why your spending pattern generally doesn't actually look like it would, right? So the hatchet comes from the name that oftentimes people have higher distributions in the front years of retirement because they're delaying Social Security, delaying a pension, letting those benefits grow. And so that creates kind of this blade of the hatchet. And then things actually, once those income sources kick on, then the distribution need from the portfolio goes down. So then you start to see that compress, and it kind of creates the handle of the hatchet going forward into retirement. But that's what that's referring to. And yeah, he's absolutely right. It just doesn't map over. And so you can't do anything, right? If you're using Guyton Klinger and it's got these rough, rigid percentages that you're looking at distributions, but that may not actually, again, translate to what you actually need to spend. And that might lead to really irregular types of spending if you were actually using that to determine how much to distribute from a portfolio for income in retirement.
Of the dozens of withdrawal strategies that I've reviewed and considered using, none of them stack up against the risk-based guardrails. Other strategies create unneeded stress. They communicate that retirement is a pass or fail sort of thing when nobody really fails at retirement.
I love this video. This guy's, he's definitely hitting on a lot of the high points. He's doing it very well, so I really appreciate that. But what you just said there about the stress, to me, that's so big when you think about a lot of the Monte Carlo-driven tools where you just get a probability of success. Again, that's something I've written about. I've written about with Justin Fitzpatrick. He has a great article all on his own at the Kids' blog where he's talking about really what we should think of that instead of thinking of 90% probability of success, thinking of more of like a 90% chance that somebody is spending less than they potentially could going into retirement, right? So thinking in terms of risk of overspending or underspending, and really the 50% probability of success becomes sort of our best guess. And most people do not think about 50% probability of success that way. I have a Gets this article on using 50% probability of success, and why that, if you use that as a constant probability of success in retirement, is actually not anywhere near as different as most people think. But that really messes with our brains, right? The way we think about it, that just does not sound right from a risk perspective. A lot of people look at that and say, no way would I want to plan with a 50% probability of success. But if you're willing to make adjustments, and if you're willing to course correct, that 50% means nothing, right? Because the 50% that when you got to that number, it assumed you weren't making any changes. In reality, you will be making changes. You'll be making adjustments. And so if you're doing that, it means nothing. It's now become a completely meaningless term. It's just a gauge of kind of how high or low risk is. And that's why I think Justin Fitzpatrick's article is great for that. And again, I'll try to go through this video, find links to all these articles that I'm mentioning, and drop them down below.
Just simply make adjustments. Stress comes from not knowing what those adjustments are going to look like in the future. Stress comes from not knowing how much of an adjustment we might need to make or how likely it would be.
So that point's very important, and he didn't necessarily give us a graphic here that I think would help illustrate that, but let me just throw out some numbers to help drive that point home. So let's say we have an initial spending. I'm just totally making up numbers, so I apologize if these don't make sense, but say we have initial spending of $8,000 a month. Somebody has $1 million portfolio, and they see their lower guardrail is $700,000. So a cut would be called for at $700,000. And let's say it's calling for a $500 a month cut. So they need to cut their spending from $8,000 to $7,500. Now, that can provide peace of mind in two different ways. One, it's helping define, okay, when I see my portfolio fluctuating, when I see markets going down, when do I actually need to be thinking about an adjustment? Well, it's not the first $300,000, right? In this case, it'd have to fall all the way to $700,000. Even once it gets to $700,000, we also know what that adjustment would be. It would be cutting back about $500 a month. Now, depending on the retiree situation, that may be more or less feasible. But if it's somebody that has some nice cushion there, they might say, yeah, I could cut back $500 a month if I had to. And that can be so impactful when it comes to really providing that peace of mind, because now you know when you'd make an adjustment, you know how much of an adjustment you'd make, and that can, again, just be a tremendous benefit when it comes to understanding the actual sort of risk in your plan, what that adjustment would be, and sleeping at night when you're going through tough times in the market.
Risk-based guardrails, we can get a feel for the likelihood of adjustments occurring, how frequently they would occur, and how that might change our spending in the future. We get to explore the difference between our current spending and the likelihood that we would need to make a change in the future, and that can help us to understand the risk that we have from our spending. It could also help us to be confident to do more things with our money. So now that you know the best withdrawal strategy for you, you need to understand one thing. This optimal withdrawal sequence that I'm talking about is just the beginning of what you need to know. You can't walk away from this video thinking that if you follow this strategy alone, that you're going to maximize your retirement savings. The truth is, we review retirement plans every single week, and no two retirement plans are the same.
Totally agree with him here. I mean, there's so much more to retirement than just the distribution plan. It's a big part of it, but we also have tax planning. We have thinking about benefits like Social Security, Medicare, how do you coordinate, optimize those, long-term care, all sorts of pieces that you really need to plan for, and I'm sure he's going to tell us a little bit more of that here.
Understanding retirement timing to coordinating the order of accounts for tax efficiencies. There's just so much more that goes into creating the retirement plan. So if you want to understand what you should focus on in your retirement plan, or if you want to see if you're on track for retirement, click the first link in the description, and you can do a complimentary quiz where you'll be able to assess your situation in 15 minutes, and you'll have some actionable information to take away. We'll see you in the next one.
Great. Didn't want to cut him off there at the end, let him get his marketing out there. And yeah, definitely impressed. I felt like it was a good, well put together video. He really covered the content well and fairly. Again, a few little nitpicky things, just more around in terminology. I don't think we actually disagreed. It was maybe just how he said it. And, honestly, when you're recording a video, things come out one way, and I'm sure there's things I probably said today that I'd just slightly tweak if I could adjust. But overall, did like that. Hopefully that was helpful to kind of take a dive into a video like that. Also do want to see if we can jump and look at some of the comments here. I think that might be, see if we've got any good ones that would be insightful to take a look at here. So looking at this first comment here, got a lot of upvotes, obviously. I really want to emphasize this last part where it says the hard part is guessing how long you'll live and spending down what you've saved and invested. I'd like to die with zero, but it's hard when you're a saver all your life. Kind of two different pieces of that I want to touch on. First is the guessing how long you'll live. One thing I like about Income Lab as a tool is you can set how aggressive you want to be in sort of the longevity assumptions. Do you want somebody to be somebody who lives longer than average or less long than average? But within that, it's actually using actuarial assumptions and updating each month within the plan, right? So I think that's much better than trying to use like a static 95 or 100 or 90 or just trying to guess some age, when you can say, okay, generally I think I'm going to live longer than average. We can use actuarial tables, say, okay, here's what longer than average actually is, and update that accordingly as you're going through a plan. The second part on die with zero, that's a really big advantage of something like risk-based guardrails approach is it's going to do a much better job of getting there. Now, because there's always going to be some cushion, it's not going to quite get you to zero. It's going to preserve a little bit of cushion no matter where you're at in your plan, but it's going to do a much better job than something like a 4% rule, where, again, you're going to build up some tremendous balances in most historical scenarios when it wasn't one that was actually near the historical worst. So I do like it much better for that. And then that final point about when you've been a saver all your life, that's a big one for a lot of people. When you're making that adjustment from saving up a portfolio and then you're transitioning into spending it down, that is going to be something that is a difficult transition for many. So this comment here from DLG 5485, just focusing again on the last part here, some research shows that dynamic withdrawals can enable more lifetime spending than the 4% rule. Yep, totally agree with that. The big lever you do have when it comes to adjusting the risk that you make a downward adjustment is where you start that initial distribution rate. But with risk-based guardrails, you're often going to see that starting above the 4% level, unless somebody's trying to be ultra conservative, that they don't have a downward adjustment. But that's going to be something more driven by their own risk preferences. If you're using more kind of a default type of assumption, it's going to be starting out above 4% because oftentimes you can. And then it's also going to be taking into account the shape and everything as you go through retirement. This comment here, talking about sequence of returns risk can blow a hole in any plan. Certainly that is a very important thing to consider. It is one of the drivers of what happens. One to point out, though, this part where he says even 4% may not be conservative enough. I don't think that's as accurate in most cases. And what I mean by that is if you're actually modeling out, okay, I can start at this distribution, I'm going to make adjustments. If I need to make adjustments, then I think it's rarely the case that somebody, even with a flat sort of long-term distribution pattern where it even makes sense to compare to the 4%, that's probably not going to be the case. You almost always probably could start out a little bit higher when you're willing to make those adjustments. Again, unique circumstances will always trump any sort of rules of thumb here. But I do think that I wouldn't be in this pessimistic camp where some people are saying, oh, it's really 3.5% or 3% or 2.5% is the most you should be taking. I think you should be able to be pretty comfortable if you're willing to make adjustments along the way, not getting hung up on whatever that distribution rate is. Yeah, kind of tongue-in-cheek here, but the 4% withdrawal rate ensures your beneficiaries will live large. Again, that's very consistent with the tremendous upside of the 4% rule article that Michael Kitces has, where, you're ultimately just building up very large nest eggs in many cases. Here's this comment from my WTF name. It's still vague for the majority of retirees on how much to accurately plan for taxable income brackets, capital gains brackets, deductions, incentive credits, Medicare premiums, and Social Security provisional income. All these different complexities. Basically saying, that's hard to take that into consideration. That is something where, again, professional software, something like Income Lab, actually does do a good job of most of these. There's always going to be some. When tax code is as complicated as it is, you can find some nuanced things that might not be captured there. But for the most part, I think you'd find it does a pretty good job of addressing these. And especially looking at something like the Tax Lab, where you can go in there and you can actually look for kind of what is my long-term tax trajectory? Are there things like Roth conversions that I can be doing? I think it is capturing a lot of that benefit to really help enhance that after-tax return somebody would have. Now, this comment here is commenting about basically, for them, they'd rather spend on their children than themselves. And I think that's perfectly fine. I actually think a lot of people probably feel that way. They'd be willing to sacrifice for themselves to give more to their children. If you're in that camp, I think it's important to think about, though, still, do you really want to be helping somebody out later in life, or would maybe earlier in life be more impactful? I really like Die with Zero, the book, and in that book, they give examples talking about just that sort of scenario, right, where you're maybe assisting with a down payment on a house. That's going to be way more impactful for most people than it would be to inherit $300,000, when they're 65, right? That's not going to make a big difference. It'll be nice. Nobody's going to turn down an inheritance like that down the road, but it probably would have been much more impactful to get $50,000 to put towards a down payment on a house. And that might be the better use of money. So that's one thing that risk-based guardrails can really help you do, is say, okay, even if I want to prioritize my children's spending over my own spending, is there a way that I can do that in a more impactful way? And can I start to accelerate some of that rather than wait till the end of my life? Yeah, this question here, I don't remember it being mentioned if the withdrawal percentage allowed in risk-based guardrails approach is nominal or inflation adjusted. Here, you can define what you want. So you can say, yes, I want my spending to be adjusted for inflation. No, I don't want an inflation adjustment. You can even use something like David Blanchard's retirement spending smile that can be automatically applied to a plan in a tool like Income Lab. So that's really going to be beneficial there. Comment here, whoa, if you're planning on making RV payments for the first 5 years of retirement, you need your head examined. Paying interest on a rapidly depreciating toy is insanity. I don't remember exactly how it was presented in the video. I'd have to go back and look at it. But to me, it was more supposed to say, maybe somebody's retiring. They want to buy an RV, right? Not that they're making payments on the RV. Although I think, if you spread those out, the interest over a 5-year period is not going to be that huge. But another nice thing about guardrails is helping people understand these trade-offs, right? A lot of people in retirement might really want to invest in an RV, to do some travel that they never did, to take some trips that they never did, to be able to have some sort of way to spend time with family. And again, that's something you can look at. You can say, yes, even if you think it's the most wasteful thing in the world, can somebody afford to do it? And if that's going to bring them more joy and more satisfaction, I'm okay with it. See this comment here, I'm sorry, but no bonds will ever be found in my account. Again, if that's what somebody wants to do, the nice thing with risk-based guardrails is you can actually do that, right? You could build in an allocation that's 100% stock allocation, unlike a lot of the research on safe withdrawal rates, everything else, where you're not going to get that, right? With risk-based guardrails, you truly can account for whatever allocation you want. Okay, so I think that's most of the comments. Let me know if you found this type of video helpful. Might do a few more deep dives of different content that's out there going forward, but ultimately wanted to talk a little bit about this video, react to that, and hopefully it was a nice discussion on risk-based guardrails and why I do think they are better than any of the other alternatives available.